You're listening to Pre-Market Prep. I'm Brianna Valesky with my co-host Joel Elconin. We're joined by Dr. Mikhail Melnik. He's a Bloomberg economist. His economics research in online commerce and taxation is recognized internationally. He's been interviewed by tons of media outlets, and his research has been cited by policymakers, including state Florida senators and other think tanks. Thanks so much for joining us this morning, Dr. Melnik. How are you?
Well, thank you.
So we got a Fed statement this week, although it seemed like sort of a non-statement more. They're looking at economic data and unsure of how to proceed. I would love to get your overall take on what they said and where they stand as far as interest rates.
Well, first of all, I know the media pays a lot of attention to every single word the Fed issues in their statement, and also the individual Fed members make in their separate interviews, but I would caution anyone who listens to that and interprets those statements word for word. The Fed has made it clear that their policy is a response to the economic reality. And I think if one wants to understand where the Fed is heading, one should look at the U.S. economy and see how that is developing. And I think the Fed is leaving itself a lot of room. If you look at the Fed statements over the past several months, they've always been sort of like, let me put it this way. When I was an economics student, a PhD student at Boston University many, many years ago, this is 2015, so exactly 10 years ago, one of my macroeconomics professors had this saying, when you're asked a question as an economist, you should always answer it by beginning the answer with saying, it depends. Because that way you'll always be right. I think that's exactly what Janet Yellen is doing. She always says, well, it depends. The policy will depend on how the economy performs. If the economy calls for a rate increase, we'll do it. If it calls for no rate increase, it won't do it. So basically, that's how you should interpret the actions of the Fed, and not necessarily pay attention to every statement, because if you did, you would already lose a ton of money. There were clear signals the Fed would start raising rates earlier this year. There was even talk about that a year ago. So we keep sort of repeating the same arguments. But I think if you pay attention to the economy, you'll notice that the Fed is not, the economy does not call for a rate increase at this time. In fact, I believe it won't call for it this year. It probably won't even call for it for another 12 months, if not even longer. So, in other words, the pressure on the Fed to raise the rates doesn't exist.
Okay.
In fact,
Dr. Melnik, let's say that today Janet Yellen stepped down, all right? And you get a call from Obama, and he says, Dr. Melnik, we want you to be the new Fed chief, okay? What would your course of action be given on the perception of the U.S. economic climate?
My response to that is let me begin by saying thank you for having such a high opinion of me. There are probably a few thousand candidates between me and Janet Yellen who would be chosen ahead of me. So I don't think I'm even on the radar screen. But since your question is more policy-driven, let me attempt to answer it. I think the Fed has trapped itself. And if I were poised with this situation, I would probably continue the course as it is. Because at this point in time, the situation is such that raising the rates, well, first of all, think about it this way. If you were to proceed with a rate increase, probably the first thing you would need to do is stop paying interest on reserve accounts of banks, on reserve balances of banks. A rate increase without that step being taken prior is sort of meaningless, and it's sort of symbolic more than anything else. Secondly, the Fed, although it's an independent institution, has to pay attention to what's happening with the Treasury and the Treasury balance. And the level of national debt is rising. And we're now at a point where a meaningful change in the interest rate would create significant problems. The U.S. economy is addicted to low rates. We've dragged it into this environment due to the monetary policy since 2007, but also in addition to that, the technological progress is driving us in that direction as well. So basically, with this addiction to low rates, a rise in the rates could be a shock. So if I were asked to take the responsibility, I would probably do nothing. Now, the question also is, should we be in this situation? In other words, was the Fed correct at getting us there? And that's where we can debate, but I don't know if that matters to traders today.
Okay, all right. I mean, because some of the data that's coming out, I mean, it's what's your take on cutting the GDP forecast for the remainder of 15 and 16, and maybe bumped it up a little bit in 17? I mean, that probably goes hand in hand with what you just said.
Well, actually, if you look at my GDP forecast, I don't need to cut it. It's already pretty low. So, in fact, what they're doing is they're sort of approaching my forecast levels. So I don't see any surprises on the GDP front. In fact, the U.S. economy is somewhat fragile. The only surprise I had this year, and you can go back to my November interview on your radio, and notice I said back in November that I expected close to zero growth in the first quarter of this year. But I didn't expect the growth to dive into the negative territory, as it did. So that was a little bit of an unpleasant surprise. The economic data right now is a little bit mixed. There are some positives. You can clearly see some positive signs there. I would mention one, for instance. People don't pay attention to the market for oil, but we've noticed a significant rise in oil production this year. So there is a rise in that area. That's probably a response to the price of oil being $60 and hanging around that level. By the way, again, back in December, I mentioned that we would stabilize at $60, and that's exactly where we stabilized. So because that's where the marginal cost of production for many of the high-cost producers was at the time. But generally, the economic data is very fragile. Look at the labor report that the market celebrated not too long ago, the May labor report. 282,000 new jobs were created. And that looked great and wonderful. But then, out of that 282,000, about 18,000, or 280,000, about 18,000 was public sector employment. So the private sector job creation was smaller, but that's not even the big dent that one needs to focus on. 72,000 jobs were added in the part-time jobs, or at least if you look at the survey of household data, 72,000 individuals indicated, or not 72,000, but the representation. In other words, there was a jump in part-time employment for economic reasons of 72,000. That's a very large monthly jump. So even that report is not all that wonderful. And if you look at retail sales, if you look at wholesale inventories, if you look at business inventories, if you look at the growth in non-residential investment in the first quarter, all of these suggest a soft behavior, soft economic behavior for the rest of the year. And so that's in line with my forecast. That's in line sort of with the forecast of the growth being just under 2% for the year, the job growth being a little under 200,000 a month for the year. In terms of 2017, I don't know where that optimism comes from. I don't see 2017 being any better. In fact, my belief is that 2015 is a somewhat decent year. 2016 might be worse and significantly worse. And 2017 may be much more in line with 2016. In other words, I don't see this as a cycle. I see this as an adjustment to the new long-run equilibrium for the U.S. economy. The U.S. economy today faces a much higher burden, public sector burden, than it ever did, and that changes its efficiency. So we're now just in a new equilibrium, and that's what we're seeing, and I think everybody needs to understand that. That's basically my opinion. So I'm not sure I see that much optimism going towards 2017. I sort of remain pessimistic.
And what about the move in gold over the last couple days? I mean, that kind of is going contra to kind of what you're saying because it looks like whoever's buying the gold or getting into the gold market here feels like the Fed, should have raised interest rates. Is not doing the proper steps to fend off inflation. So, based on your take here, gold's a fade here at the $1,200 level.
I think that the gold market participants right now are doing the right thing. If I had money, in other words, if I wasn't an academician, I would probably be joining them. Although I don't see any major surge in the price of gold. Don't forget what surged the price of gold or what helped it surge drastically in the past decade was the purchase of gold by central banks. That's not going to be present for a while because the countries that were accumulating gold simply don't have enough resources today to do that. So those big buyers are out of the picture. Now what you're relying on is essentially speculators and hedge funds. And that's not as stable. So that's why I don't see a huge surge happening anytime soon. But I do believe that gold is sort of on a slow but upward trajectory. And there everything is fine. What we're noticing right now, and this is actually quite interesting, we're noticing a fundamental change in the inflation expectations. If you go back in time just 3 months ago, the expectation was the U.S. economy sort of is in a free fall. Potentially there won't be any inflation for decades to come. So there was a pressure downwards. And that was seen not only in the price of gold. In fact, in the price of gold, we really didn't see that much action. We saw that in TOT. We saw that in long-term treasury bonds, 20, 30-year treasury bonds, when their yield in the U.S. dropped to 2.3, 2.4%. That was really interesting. Now what you're seeing is something far more interesting. The yield curve is sort of becoming steeper. If you looked at the market over the last couple of days or the last week, you would have noticed something interesting. The 10-year and the 5-year yields were dropping on a downward trajectory, whereas the 30-year yield was rising. And that's sort of an interesting expectation. It tells me that the market expects the economy to remain soft. The market is starting to realize that the Fed is in it for the long haul, and that potentially years later, there might be some serious inflationary implication. Now, I continue to believe that if you wish to watch for inflation, what you need to watch for is the U.S. dollar, because that's exactly how it will appear. It will not be the printing press. Your first symptom will be the dollar fundamentally weakening, and that's how inflation will appear in this economy, because otherwise our productivity growth is sufficient to sustain relatively low inflation. Furthermore, the planet still has untapped labor resources, untapped resources broadly defined to avoid sort of a crunch in resource supply and a rise in prices. So do I believe that gold is a hedge? Gold is not just a hedge against inflation, by the way. I believe that, and again, I might be wrong on this. Obviously, I'm not a major hedge fund to understand where gold is heading and how it behaves, but so I don't know what exactly motivates them, but I would guess that gold is a hedge against a major financial collapse. And every time you see something like Greece appearing in the news or another country appearing in the news, there's always a little bit of a spark. But I think it'd be interesting to follow the yield curve. Again, the bond market can get it wrong, and the bond market in the last 2 years has made at least two major errors. So I wouldn't recommend interpreting it on a daily basis, but there is a little bit of that steepening of the yield curve that suggests that indeed inflation expectations are changing.
Dr. Melnik, we've only got a couple minutes left, so I'd love to get your take on what's going on with Greece right now. I mean, they've hit multiple deadlines and they haven't reached a deal. They've got another one set. If they don't come to a deal within the next couple of days, is this the beginning of the end? Are we going to see people start to pull a ton of money out of Greek banks because they have no confidence?
Well, first of all, I can't predict what politicians will do.
That's true.
I believe the problem of Greece is that there was an underlying economic crisis that was politicized and made into a political crisis. And whenever an economic crisis becomes a political crisis, and take it from someone who survived through those back in Russia during the early years, whenever you make an economic crisis a political one, it makes it far more difficult to address. I'm actually surprised that we're still talking about this and there hasn't been a partial default at this time already. So I know what should be done, I think, or at least as an economist, I believe there should be a certain course of action. The problem with Greece is that I think if Greece is bailed out, in other words, if the demands of the Greek government are met, then that could set precedents, and that could trigger a whole array of events in countries like Spain, Italy, Portugal, even Ireland. In other words, other countries within the European Monetary Union may say, well, why not move in that direction? That would be quite detrimental. Now, the Central Bank of Europe may be willing to bail out Greece and may be willing to bail out everybody, because that would only mean more money printing and the lower value of euro, a lower value of the European currency. So that would be all wonderful. But politically, that becomes a very difficult thing to swallow in Germany, in France, in England, and other countries. So even though England is not part of the European Monetary Union, it is part of the European Union, it closely watches it. So I think because of that, if I were gambling, again, I would not recommend gambling on the decisions made by politicians, but if I were gambling, I would think that Greece is slowly but surely moving towards the exit point.
All right, Dr. Melnik, it's been great. You've given us a lot of wonderful input here on Greece and the interest rate situation. We'll be following it. I guess we're going to get another round of QE then before interest rates go up with this, based on your outlook of the economy.
Actually, the QE never stopped. That's the whole point of this. If you look at the Fed has done something really wonderful. They started paying interest on reserve balances of banks, right? And that is a hidden QE, because it is QE. It's expansion of the monetary base. They're basically giving money to banks, and yet it's not asset acquisitions. So it doesn't appear directly on the balance sheet in the form of bond positions that everybody pays attention to. So QE is still ongoing. We never left QE, because if we left QE, just look at a couple of interesting things and tell me if you believe in coincidences. The Treasury does a 30-year auction. The morning of the 30-year bond auction, the interest rate on the 30-year bond has the largest drop, I think, this year. Can you explain that? Is that a coincidence? You know, there is a supply of more bonds, and all of a sudden the price increases on a rising supply. To me, that's sort of the Fed acting, right, or other central banks potentially. So we have these sort of coincidences going on. The problem is, and again, we could continue this discussion, where I blame the Fed, and you don't have much time probably for this, but where I blame the Fed is that the Fed's lack of communication skills and this policy stance, the current policy stance that's entrapped, it cannot be changed, so we're stuck with it, creates a problem. It creates uncertainty and creates excess volatility, which we don't need. And whenever we have excess volatility, market participants tend to suffer, risk increases, and that causes the economy actually to pull back. And that's part of the problem we have today. We would be much better off if our public policy makers were to come clear or stop sending mixed signals. It was funny. I made this comment to a Bloomberg journalist, and I can make it to you, but I made it then. It was much more timely. When the mortgage rates were rapidly rising a couple of weeks ago, I said people are trying to lock in their mortgages before the rates go down. To me, as an economist, it was clear that that rise was temporary because it's not sustainable. Otherwise, the housing market, the only engine of growth, starts to choke. Nobody's going to permit that to happen, or at least want to permit that to happen. So, and yet, market participants don't know that. They don't see that way. So they react differently. That's a problem.
Okay, we've been on the line with Dr. Mikhail Melnik. He's a Bloomberg economist, giving us a great outlook on the interest rates and great information. We really don't discuss it in detail like that, and I'm sure Garrett was bummed he wasn't here to interview you, but it was great. Thanks for the information. We'll talk to you soon.
Thanks, Dr. Melnik.
Thank you.